Have you ever looked at your bank account and wondered why your money isn't working harder for you? Or felt overwhelmed by all the complicated investment strategies that promise wealth but require decades to understand? What if I told you there's one simple rule used by professional real estate investors that could transform how you evaluate financial opportunities? A rule so straightforward you can calculate it in seconds, yet so powerful it can help you build wealth methodically. Welcome back to Richly Spoken, where we break down complex financial concepts into actionable strategies. Today we're exploring the 1% rule that will change your finances forever, a time-tested formula for identifying potentially profitable rental properties that could help you achieve financial freedom. Subscribe, like, and stick around, because by the end of this video, you'll have a powerful new tool for your financial toolkit that might just change how you think about building wealth through real estate. So, what exactly is this mysterious 1% rule? In simple terms, it's a guideline used by real estate investors to quickly assess whether a rental property is likely to generate positive cash flow. The concept is beautifully straightforward. A property's monthly rent should be at least 1% of its total acquisition cost. This includes both the purchase price and any necessary repairs or renovations. Let me break down the formula for you. Monthly rent, 1% of total property cost. Or, to put it another way, gross monthly rent, purchase price, where 1% rule ratio. Now let's make this concrete with a real-world example. Imagine you're considering purchasing a rental property for $200,000 and you anticipate needing to spend $20,000 on renovations. That brings your total investment to $220,000. Applying the 1% rule, $220,000 x 1%, $220,200. For this property to meet the 1% rule standard, it would need to generate at least $2,200 per month in rent. Why is this threshold so important? Properties that meet or exceed this 1% benchmark are statistically more likely to generate positive monthly cash flow after expenses. Those falling significantly short may struggle to cover your costs, let alone generate profit. The power of the 1% rule lies in its elegant simplicity. Let's examine why this has become such an enduring guideline in real estate investing. First and foremost, it's an incredible time saver. Imagine you're looking at dozens of potential properties. Instead of performing complete financial analyses on each one, you can use the 1% rule to quickly filter out the obvious poor performers. This lets you focus your valuable time and energy on the most promising opportunities. Second, it works across different property types. Whether you're evaluating a single-family home, a duplex, or a small apartment building, the calculation remains the same. This versatility makes it useful whether you're just starting out or building a diverse portfolio. Third, it helps overcome psychological biases. Many of us naturally prefer properties in our immediate area, but what if better opportunities exist just 30 miles away? The 1% rule gives you an objective numerical standard that can reveal these hidden gems. Finally, it promotes financial discipline. By setting a clear benchmark, the rule helps prevent emotional decisions and keeps you focused on the numbers that truly matter for building wealth. Now, before you run out and buy the first property that meets the 1% rule, we need to have an honest conversation about its limitations. The 1% rule is a fantastic starting point, but it's not a comprehensive investment analysis. Critical expenses. The 1% rule doesn't account for a decent high. Property taxes, which can vary dramatically between locations. Financing costs, including mortgage payments and interest rates. Maintenance and repair costs, which can be unpredictable. Property management fees, if you choose to hire professionals. Vacancy rates, which affect your actual annual income insurance costs, which depend on property type and location potential for long-term appreciation, which might justify a lower ratio. As we move into 2026, savvy investors recognize that relying solely on the 1% rule can be misleading in some market conditions. In high-cost areas, finding properties that meet the 1% threshold can be challenging, while in lower-cost markets, many properties might easily exceed it without necessarily being great investments. The key insight here is that the 1% rule is a screening tool, not a decision-making tool. It helps you identify candidates for further research, but shouldn't be the sole basis for your investment decision. Once you've mastered the basic 1% rule, it's time to explore how professional investors adapt and extend this concept for more sophisticated analysis. First, consider applying the rule to private equity real estate investments. Even if you're not purchasing properties directly, you can still use the 1% rule to evaluate opportunities presented by private equity firms. Just apply the same calculation to their purchase price and projected rents. Second, understand the legendary 2% rule. This is essentially a more stringent version where the monthly rent should equal at least 2% of the purchase price. Using our earlier example, that $220,000 property would need to generate $4,400 in monthly rent. While such properties are extremely rare in normal markets, often called unicorns in investing circles, they're worth recognizing when they appear. Third, adapt the rule for different market conditions. In expensive coastal cities, you might need to accept 0.7% or 0.8% as reasonable, while in Middle America, you might hold out for 1.2% or higher. The key is knowing your local market's typical ranges. Most importantly, always complement the 1% rule with deeper analysis. Consider factors like neighborhood appreciation trends, local employment growth, and development plans that might affect future property values. Given today's dynamic real estate landscape, how should you practically apply the 1% rule? Let's discuss implementing this rule in 2025's market conditions. The reality is that finding properties meeting the strict 1% rule has become more challenging in recent years, as property prices have increased in most markets across the country. This doesn't mean the rule is obsolete, rather it means you need to be more strategic in its application. When a property doesn't quite meet the 1% threshold, consider these factors. Strong appreciation history in the area might justify a lower ratio. Exceptional condition requiring minimal immediate maintenance. Rent growth potential through strategic improvements. Economic fundamentals, like job growth and population trends. Better metrics to combine with the 1% rule. Cap rate, capitalization rate, net operating income, purchase price cash on cash return, annual pre-tax cash flow, total cash invested, total ROI, considering all income sources including appreciation. Remember, the goal isn't to find perfect properties, but to find properties where the numbers work in your favor. The 1% rule gives you that crucial first data point in your analysis. So, let's bring this all together. The 1% rule isn't a magic formula that guarantees investment success, but rather a powerful filtering tool that can help you quickly identify potentially profitable rental properties worth deeper investigation. The real power of this approach lies in its ability to bring discipline and objectivity to your investment process. By using this simple calculation, you can avoid emotional decisions and focus on the fundamental math of wealth building through real estate. Remember, the most successful investors aren't those who find secret tricks. They're those who consistently apply proven frameworks like the 1% rule, then complement them with thorough due diligence. As we've discussed, always look beyond the simple ratio to consider local market conditions, property-specific factors, and your personal financial goals. If you found this breakdown helpful, we'd truly appreciate if you'd like this video, subscribe to our channel, and hit that notification bell so you don't miss our upcoming videos where we'll break down other powerful financial rules and frameworks. Now we'd love to hear from you in the comments. Have you used the 1% rule in your investment analysis? What other financial rules or shortcuts have you found helpful in making better money decisions? Thanks for watching, and remember, financial freedom isn't about finding one magic solution, but about consistently applying the right tools and frameworks. Until next time, keep making your money work harder for you.